Welcome to the Nadex Application and Strategy webinar series. My name is Daryl Martin. I'm with ApexInvesting.com, and I'm a trader, just like you are. Apex Investing is a community of traders that just collaborates together to learn how to best trade the markets, and we all build on each other's knowledge and help develop systems to make them better and better. So feel free to check out our site. We got to open up with disclosures. Obviously, trading, futures, options, swaps, anything like that does involve risk. So make sure you know what you're doing before you do it. And this is unique information provided by Apex Investing Institute. Again, futures, options, and swaps involve risk. May not be suitable for every investor. Any trading decision that you make is your responsibility. The information presented in this webinar is for informational purposes. The contents of the webinar are not an offer or a solicitation to buy or sell any particular financial instruments offered by Nadex. Past performance is not indicative of future results. So all that just to be said, to make sure that you are aware you need to think before you trade. You need to demo before you trade. So let's talk about real quick how to get a demo account if you don't have one already. Let me just go through it real quick with you. I know a lot of you already have those set up, but right over here, you just go over and under trading, you'll see the demo trading platform. You can also, of course, download their iPhone, Android, and Windows app. And you just got to put demo dash your demo username in order to be able to log in on it. You click on that, it takes about 30 seconds. You fill this out, they'll email you a password. So, and then you can log in. You can update your password to one that you'll remember for next time. If you don't do that, you'll probably forget what it is. And so once you log in, you can, like I said, just easily update it. Now, your demo will last for a couple weeks. If you want to get that extended, it's really easy. Open an account and fund it with, whatever amount you want to. The minimum requirement to fund an account, not a fee, but just a deposit, is $100 or more. If you place one live trade or more, then you can call up customer service or email them, and they will extend your demo for a year. Okay, so if you funded with at least $100 or more and placed at least one trade, live trade or more, they'll extend out your demo for a year for you. When you're ready to get that account funded, just go over here to open an account for free, fill in the information, and of course, Nadex is open to a lot of different countries now, and all across the world now, like something like I think 49 countries. And obviously, international, the verification process can take a little bit longer, but just fill it out, start filling stuff out, and then they'll get you underway. Okay, but it's a very simple, very easy process. Nadex is the North American Derivative Exchange, located in Chicago, regulated by the CFTC, and all funds are segregated. Now, what about ApexInvesting.com? You can hop over here, and just on the right side, go ahead and click Get Free Access. Okay, click on Get Free Access. And doesn't cost anything at all. And you can log in. There is literally like tons of training and information for you on the site. Don't get overwhelmed by it. Focus on a couple things. Use the forum. The forum's really helpful. Just search for what you're looking for. And if you can't find anything, just ask. We'll be glad to help you out. We have a whole chat section right here. You can chat and ask questions. We'll sort of point you in the right direction. We have a free scanner for binaries and spreads. We'll be talking about that today that you can use. We also allow our deviations level now for over 20,000 instruments, obviously including all the Nadex ones. And we show you how to get that set up for free as well. So a lot of cool stuff that you can get in there. You get going with a news calendar, which is very helpful. You're going to want to know when news is coming out. That's part of any trading day. Know what news is coming out or did come out, so that way you can plan ahead for your day. Okay? So really, this is just, hop onto Nadex.com, hop onto ApexInvesting.com, get your education, get your demo, get your live, and get going from there. But there's a lot of information on the site. Our schedules, our webinars, every time we have a webinar, it's listed right here, weekly webinars, big red button. And our recordings, if I zoom back to normal there, our recordings are listed under webinar recordings, newest webinars. So this is where this webinar will go and where previous webinars will go as well. Okay? Anyways, all right, so that's enough about that. I'll go ahead and put this over here on the binary scanner. We'll come back to it. There's a whole course on the scanner and how to use it in detail, but it's basically there to make it really easy for you to be able to trade binaries on Nadex or spreads. We have a spread scanner as well. Couple updates for you. Corn and soybeans rolled forward on Thursday, so you need to make sure you've rolled that. Oil rolled over the weekend. Make sure you're looking at the right future contract. If you don't know how to get futures data, or Forex data. We show you how to do that for free right here under Education, Getting Started. Okay? So if you go to that, we literally walk you through it step by step how to get a free platform, free data, all that stuff step by step. So make sure to go to that third link under Education, Getting Started and Set Up. Okay? We also have a section on here to help you with these rolls, which is pretty simple. We list when markets are rolling. So 6 p.m. the night before, they're going to roll over. So, now it's the 20th. So on 6 p.m. on Friday, technically, oil rolled. And so when the markets open back up on Nadex for oil on Monday, then they were on the new month. And if you just highlight over that, it'll tell you what the ninja symbol is and what the think or swim symbol is. Okay? So pretty, it's just a nice, helpful little link. And, what are the underlying markets? There's a whole list of them right there. Again, all this is inside the scanner under Nadex information. So here's all the future symbols for all the markets currently, and that updates every time they roll over. And links, as well as, currency futures, if you want to know about those, where those are at. Okay? So, like I said, a lot of little helpful information on the site, but it really helps to know about those rolls. They're sort of intuitive anyway, but people, sometimes don't notice them. So we send out notices on our Twitter and on our Facebook. We're adding more and more notices to Facebook now, but we send it on our Twitter definitely, and we're going to start putting them, like I said, on Facebook, on our webinars and all our videos and all that stuff. But we also say, hey, Nadex is rolling over. In the contract name itself, like if I just open a contract up, okay, it'll actually say the month. So if you're inside the Nadex platform, notice that says June right there, okay? We even have the month at the top of the binary scanner. We say, what is the market it follows? What's the ninja symbol? What's the generic symbol? So all that information is right there for you all over the place. But I don't know how many times I get people go, my chart doesn't line up, or my chart isn't loading data, or because they haven't rolled their month over. So just a simple thing that should help you out, okay? That's how the binary scanner works. And how you can get access to the information. A reminder, Nadex is opening up internationally, so still nailing down the verification process. So, like I said, it may take, 1 or 2 or however many weeks there to get you opened, but if you are outside the U.S. and you're on the list of countries from the sign-up page, then go ahead and just get this process started. A big change that I'm very excited about is the NQ, the Nasdaq 100 US Tech 100 spreads. I've been really pushing for this for a long time, and it is coming to effect. I said as soon as April 30th. So sometime in the next few weeks, hopefully we'll be able to see that update. But right now, the Nasdaq spreads tick in 1, whereas the underlying market ticks in quarters. So it ticks really slow, and the market can move quite a bit, and you only make a few bucks. Well, they're going to change that to be more like the S&P with the US 500, where it ticks in 0.1. So it's going to make the NQ spreads like an awesome thing to trade, and I'm really excited about it. We like trading the NASDAQ. We do a lot of NASDAQ trading in our room. Kevin leads a lot of that. And so that'll really open up the NASDAQ spreads to those who are wanting to use spreads in place of futures. Okay? All right, so what are we talking about tonight? Tonight, we're going to be talking about range-bound trading and how to know the expected move of the market. All right, so again, range-bound trading and how to know the expected move of the market, because, let me just ask you, why might you want to have an expectation on movement in the market if you're range-bound trading? How might that help you? Do you think? Okay, there we go. Getting a couple answers. All right, so to challenge a couple more, you think about what is range-bound trading. It's where the market stays inside of a range. Okay, so you don't want it to go below a certain price or above a certain price. So if you want it to stay inside of a range, might it be helpful to know what the expected move is between now and expiration? If you're wanting to buy one that it stays above and sell one that it stays below. Exactly. Okay. So, but yeah, exactly. Understanding the expected movement on a market for the next 20 minutes or hour or 7 hours can greatly help you identify what binary is too close, what binary is too far away, potentially, for the trade that you choose to do. Okay? So it's very important to help you choose the right binary for your range-bound trading strategy that you're implementing. And then how to potentially profit on both buying and selling a Nadex binary at the same time. Now, obviously, two different contracts, but using two of them at once, even if the market's not doing anything. There's a lot of flat markets during the day, sometimes for a week. I mean, last week, Tuesday, Wednesday, Thursday had, all day Thursday, part of the day Wednesday, very flat. So we'll show you a couple, ways to take advantage of that. Okay. All right. So where to find? I did repeat. Yeah, I already did. All right. So where to find education on the basics of binaries? Okay. Um, Hop on over to our site. If you don't know what a binary contract is, you don't know how to trade it, we have a few different. We have courses under the essentials section. Okay. You can go over here, and we got strangle courses, butterfly courses. Okay. Um, we even have trend catcher courses and all different things. But I mean, they're right there. Butterfly course right there for you. Okay. You can also go to education, and if you scroll on down to the there's basically you can go to the webinar recordings. You'll find a bunch of recordings, but also you'll see Nadex binary webinars, and that's a great section to go to because you'll find that you'll see like binaries 101 and there's some really like advanced and basic stuff in there. So this is a good place if you're just trying to find different topics on binaries, misconceptions, which mess people up a lot. It's a great webinar. Um, what's in the money, out of the money, at the money. So just a lot of introduction to binary options, things like that. A lot of little webinars that will help you go over basics. So if you don't understand what they are at all, definitely recommend you go and you check those out. Okay. And then we have the 15-minute YouTube channel as well. If you go to just even Nadex's YouTube channel, we have a strategies and applications section, and it goes over basics. So if you haven't seen that before, let me show you. So on YouTube /Nadex, and all these videos are like 15 minutes in length. And let me pause that. There we go. Okay. So they have the introduction to binary options, but if you go to their playlist right here, then let's see here. Oh, they updated their playlist. I gotta update that. Okay. Okay, I'll have to come back and show you that here in a little bit. Let's see here. Where did they put the new playlist? Here we go. Okay, so here's where the videos are at. Under trading strategies, they basically moved them all into that section. And so we go in, and most of these videos that we've made right here are literally about 15 minutes long. Okay? So you can go in and learn really basic stuff about Nadex and basics on, trading in the evening, the morning, Eurodollar contracts, oil contracts, in the money, out of the money. I mean, just all sorts of short videos that we put together. So they just added that to the trading strategies section on YouTube. Okay? Just trying to help some people that are brand new know where to find it. And let's see here. Question: is Apex owned by Nadex? No, Apex is not owned by Nadex. We're completely separate. I trade on Nadex. A lot of traders have complimented that. Nadex asked me to do webinars for them, so I do. I hop on and share what I've learned with y'all. Let's see here. I'm not an employee of Nadex, and it's a completely separate company, so nobody owns either part. All right. So expirations. Okay, we have on binaries. You have weekly expirations. You have daily expirations. Okay, so weekly is obviously expiring at the end of the week, like at 3 o'clock on FX, at 4:15 on U.S. indices, things like that. You got daily ones expiring at different hours. So 4:15 for U.S. Indices, 3 o'clock or actually there's 3, 7, 11, 3, 7, 11 a.m. and p.m. for FX. You have 2:30 for oil, 1:30 for gold. Those different times, by the way, are besides all the new FX ones they have in there. They're basically set to close at the time that the pit closes. So like the gold pit closes at 1:30, so gold binaries, daily binaries close at 1:30. Oil pit closes at 2:30, so oil binaries close at 2:30. Okay. They also have the intraday expirations, which are 2 hours long. So if it expires at 10 a.m., it starts at 8 a.m. If it expires at 8 p.m., it starts at 6 p.m. Okay? They have 20-minute expirations on the U.S. indices, and they start at 9:40 and they go to 4 o'clock. So every 20 minutes on the S&P 500, the Nasdaq, the Dow, and the Russell. And then they have 5-minute expirations on the pound dollar, euro dollar, Aussie dollar, and dollar yen. And those are just like literally every 5 minutes from 6 o'clock going until 5 o'clock, 6 p.m. to 5 p.m. They have them basically the first 11 expirations because the last one has the expiration of the hourly, the intraday one there. So there's a lot of expirations on Nadex that you can choose from. 5 minutes, see, this is about longer term. Longer term, of course, is relative depending upon how you like to trade, how you've traded. 5 minutes would definitely not be in the longer term category. So something I probably wouldn't do a lot of butterflies on 5-minute contracts. You could try it, but most of the ones I do are usually looking at 20 minutes, intraday. Occasionally, I'll be using dailies as well. Okay, I don't do too many weekly contracts because, see, the thing with a binary is the maximum value, at least on a single contract, is $100. So it's not like if you hold on to it for 4 days, you make more than if you hold on to it for a week, a day, 2 hours, 20 minutes. So why wait a week to make what you can make in a day, in an hour, etc. Usually when people are doing weekly strategies, they're doing it because of the advantage of weekly, and there's really not a massive advantage in my book on weekly, even though, you can do these on weeklies. It's just not my preferred method. All right, so we know we have all these expirations. Why would you want to trade a range-bound strategy? Okay? So again, why would you want to trade a range-bound strategy? Some days the market, does not trend at all. Would y'all agree with me on that? Like there's days that the market just doesn't do anything? So, yeah. All right, what about during the day? Do you think there are certain times of day where you see the market usually sort of flatten out? It could be, lunchtime. It's a very often time to see the market just do a whole lot of nothing. Okay? Other times could be in the evening. So, sort of the Asian session type thing for certain, FX instruments. Yeah, right around 12 o'clock. One person brings 12 o'clock up, definitely. Here's just a chart from, let's see, looking at today, if I scroll back, we had a nice, trend going on in the S&P in the morning, and then right there around 11, it just, nothing. Just flat, 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 right? Well, how can you make money on that? It's not moving at all. That's the whole point. That's what we want to do. We want to make money when the market's not moving. So identifying certain times where the market's not flat. Okay? Question comes up, who is taking the other side of the trade when we're using a range-bound strategy and the market is not moving? It doesn't matter whether you're using a range-bound strategy or a directional strategy or the market's moving or not moving. That doesn't impact who takes the other side of the trade. So the other side of a trade is an exchange, so you never know who's on the other side of the trade. That's the whole point of an exchange, is have transparent pricing, okay, with anonymous, like you're anonymous and the other side is anonymous. Like you don't know who took your other side. But that means other traders and market makers will be taking the other side of the trade. So, or another word for market makers, liquidity provider, okay? So another trader may take it, or liquidity provider may take it. Nadex does not trade against you. They make money on fees, not on trading against you. Even market makers don't really want to trade against you. They actually want to buy from you when you sell at the bid, and they want to sell higher to somebody that buys back at the offer. They're trying to make the spread versus be directional. Okay, so we want to take advantage of these flat markets. All days are not the same. All periods of time during the day are not the same. I think everybody would, if you've traded for longer than a week, you should have figured that out, right? So all days are not the same, and you never quite know 100% what it's going to be, but you can see patterns. Like people go, well, it's impossible to predict anything. Da, da, da. Well, I can tell you that I live in Dallas, Fort Worth. and in Texas, and I can tell you that when the highways are going to be jam packed and slow, right? So that is because of people, right? I know people are going to, getting out of school, getting off work, they're commuting. I can tell you in the morning, if I, like when my wife takes my daughter to school, she leaves at this time. It takes her 15 minutes to get to the school, to take my daughter to school. If she leaves, a little bit later, it could take an hour. So it's about knowing that pattern, that timing of when there's movement and when things are slow. And you'll see a lot of these patterns occur over and over and over again. So get some other DFW traders. Awesome. So Dallas Fort Worth. But so you can recognize patterns in traffic at certain times of day because of how people's lives and how they act react. Okay, the same thing happens in the market. Floor traders go home. Europe goes to sleep, or floor traders go to lunch, and only half of them come back. Okay, Europe, they're going to bed. They're logging off. The late night traders are done. Okay, so or maybe they're not going to bed yet, but at least they're leaving for the day. And so those just the way that traders are moving the market, because when they're active, when they're not, you can know that. If they say, they have a lot of construction on all these freeways here, like every 5 seconds it seems like, but they'll say, these lanes are going to be closed on these days and these times. Well, I know it's going to be really congested then, right? Well, you can sort of do the inverse. This news is about to come out. I know the market's probably going to really move fast, okay? So just understanding where that congestion comes in and where that volatility comes in, that can help you pick better times of day to range bound or not range bound trade. If news is coming out, probably not the best time to do a range bound trade unless you have the stats on it. We post a whole bunch of range bound trades around news that we know doesn't, like 10 out of 12 times, does not have a significant impact. Okay? And if it does have a big impact, then we do the opposite. We do a strangle where we're going both directions. Okay? So in this case, our focus tonight is a strategy to take advantage of range-bound markets, times a day, etc. And you want to have multiple plays in your book, or you want to have multiple, golf clubs in your bag, right? You don't want to be hitting, you don't want to be down on the, green and using your driver. You don't want to be at, getting ready to, drive the ball and pull out the putter and try to, knock it all the way down to the flag. So it's good to have an idea, have different ways to take advantage of different market conditions. So you're not sitting there going, man, it's not moving. I can't make anything. It's not moving. Well, okay. Well, then now it's time to pull the putter out. Okay? And this will help you adapt to market conditions and help you to look at the market as not just a buy or sell, which is very helpful. Okay, so what's needed for a range-bound market, or to take advantage of the strategy and put the system into place? Well, obviously you want a flat, ideally not trending market, or if it is trending, it's a slow trend. It's not like a rocket ship. Okay, if the thing's just going up, 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 it's going to be very challenging. Let me show you an example here, and I'm going to talk about 20 minutes, but also talk to you about how to apply it to even longer time frames. What I have, this is an Apex chart from the Apex toolkit that we have over on our site, okay? And what I have over here, let me hide this, move the volume up here. Hold on, then I'll shrink this back down. It's basically what the expected ranges are for this 20-minute period, okay? Basically, we're saying we don't really expect the market to close outside of these boxes for the next 20 minutes. Okay? And we calculate these constantly for every 20-minute period, unique for every day of the week. All right? And if you go in, you can see, hey, this is basically where we said it should expire. That or less will expire right at it on that time. Stayed inside the range, just above the range on this one. The last bar on the line is that's the first 5, 10, 15, 20 minutes, okay? And for the rest of the day, we stayed inside the ranges, like as far as closing. All right, some of them were right at it, but most of them were right inside the range, the expected range. So even when the market trended, like right here, the market flew up, but still stayed inside the range. And why do you think these boxes right here, why do you think they're bigger at this time of day? What do you think's going on? There's more volume. Why is there more volume right there in that first, hour or so of the day? There's a lot more traders. Europe's there, the US is there, the stock market is opening at 9:30 in the morning, right? So earnings are happening, all sorts of stuff like that, releases are coming out. So stocks open up so the indices move more. All these trades go on. There's 500 stocks in the S&P 500. There's, 2,000 in the small caps. There's 100 in Nasdaq. There's 30 in the Dow. Okay? So all those stocks open up, and so you notice it gets larger. But notice how all of a sudden it gets smaller and smaller and smaller. And then you'll actually see it pick up, and it starts actually getting a little bit bigger near the end of the day. Okay? So you can see when the range is getting smaller, and you can also see when the range is getting larger. Another way to see that down here, this is part of the expected range. This orange line is basically saying how many ticks of movement are expected, or points of movement are expected. So you can notice how it drops down and it goes back up. So it's way up here. It almost cuts in half, or more than in half, by lunchtime here. And then volatility picks back up a little bit. Okay? So just visually seeing what that expected move is obviously helps out a lot. So ideally it's not really trending as you're doing this unless it's a slow trend, but having those expectations will help you out even if it is trending. Again, it doesn't matter if the market moves. It can go up, it can go down, it can stay flat, and you're still able to be profitable on the strategy as long as it doesn't end up going up too much, expiring, higher than the binary you sold, or expiring lower than the binary you bought. So in this case, we're doing what's called an in-the-money binary, ITM, in the money. We're not doing, at the money, and we're not doing out of the money. Why are we doing in the money and not at the monies or out of the monies? So who knows what that benefit is? Like, why would you have to do that to do this strategy? Yeah, you're saying the statement is true and that it's going to remain true. Okay? Like, the market will expire greater than, 2030. Okay? Well, remember, we want the market to be able to be flat or go up or even down a little bit and still make money. So in the money means that we're buying a contract that's already below the market. And I'll show you like some I did right here at the end of the day here in a little bit. But if you look over here at this, like if I was going to go in here and do these contracts, the ideal time, if I say hop at the top of the 20 minutes or top of the hour or top of the 7 hours till expiration, whatever it is you're doing, then my low of my range here is 2093. Okay? So I would actually be buying, somewhere around 2093, saying the market's going to stay above 2093. Okay? And I'd be selling, say there's 2098, saying the market's going to stay, below 2098, because when I sell, I'm saying the statement's going to be false. So if I sell a US 500 greater than 2098, at 1120, then I'm saying it won't be greater because I sold it. I'm saying the statement's going to be false. I'm saying it's going to be less than or equal to 2098. So as long as the market stays above 2093 and below 2098 as of expiration, I'm able to be profitable. Okay? Does that make sense so far? We'll go into more details, but so far does the idea make sense that we're going to be selling a contract above the market? We're going to be buying a contract below the market. So question comes up, can you do this every 20 minutes, every one of those boxes? Yeah, you could do this every 20 minutes. I mean, there's some things to pay attention to that we'll talk about. Okay? But yes, it's possible to do one every 20 minutes, every hour, every 7 hours. Maybe you have to do them at night. Okay? Now, these are 20-minute contracts because remember the S&P 500 has 20-minute contracts during the day. Okay? So, and I will show you orders and examples on the platform as we get there. So I just want to make sure that first you understand the concept. Okay? We're buying below the market. So if the market's sitting at 2095, would we buy a 2098 contract? If the market's at 2095, would I buy a 2098 contract? No, it's above the market. It'd have to move up for me to make money, right? So, but if I bought the 2093 and if it's at 2095, market doesn't have to move at all. It can stay flat. It can move up. It can even go down a little bit, and I can still be profitable. Okay? So, any questions so far on just the basic concept of we're buying a binary below where the market's currently trading? Okay? The underlying market is, the indicative, whichever one you're looking at there, and selling one above. Okay? So, which is called a in the money contract. Because if the market didn't move and expired right there, that trade would be profitable. It's already in the money. You want it to expire in the money, and when you're doing a range bound, you want them to start in the money. Okay? So hopefully start and stop and expire in the money. Those red and green boxes, yes, are the range part. So if it's saying that the market may move, 2.5 points up or 2.5 points down from high to low, 2.5 points, then that's your range. Okay? All right. So now, what is longer term? Longer term, like I said, could be 20 minutes to you. That could be a long time. Maybe it's 3 hours. Maybe it's 10 hours. Maybe it's a day. Maybe you do a weekly. Okay. But I mean, you could come home at 6 o'clock and put these on. For an 11 o'clock expiration. You could put them on for an 11 p.m. expiration, 7 a.m. expiration. Things like that. I mean, a lot of times, 3 a.m. expiration. You may hop in the market. FX market sort of goes quiet around 2 o'clock often. You may hop in at 2, and maybe you choose an 11 right then. Okay? So you can take advantage of the London session, the Asian session, the U.S. session. All right? There's a lot of different ways to do it. And so, yeah, putting this together where you buy a binary below instead of a binary above is what I have defined, what I've termed, it's been repeated a lot, but I've actually called an iron butterfly, iron binary butterfly. Okay? Iron means you're collecting premium. So, and it's range bound. Okay? This would be one of the ways to do a butterfly on regular options. There's multiple types of butterflies on regular options. All right. So reading the current market condition does not mean it's going to be the same all hours. You got to really remember that. 20 minute, by the way, is personally my preferred period. Okay, that's what I enjoy trading them on. And I'll show you why here in a second. So if I go in and I like to see a couple things. All right. But when I do this, what I like to see is, number one, I like to see volume not exceeding expectations. Okay? So if doesn't mean I'm always going to get that. Sometimes the volume's going to be a little bit above it. If it is above it, I don't want it to be way above it. Okay? So maybe just on that line, we're just not getting a lot of volume. Volume's not exceeding expectations. The perfect setup is when volume's not exceeding expectations and you have a really wide range. Because then there's a lot of premium, you can get them really far away. That's like the ideal setup, okay? But ideally, volume, this is way above. You can tell over here, I mean, it's just exceeding a little bit, but really not that much, okay? So just barely above it, but can you see the difference? I'm trying to make this where you can really, expectations is this little, yellow line you see here, okay? That's the expected volume for what I call a 4-minute rolling period or a 5-minute rolling period. So the last 5 minutes. In that 5-minute period, what is the expected volume? And if I can see it's not really exceeding expectations consistently, then that's usually a good setup for a butterfly trade. Okay? Because not a lot of volume usually means not a lot of movement. Okay? Yeah, right around 1 p.m. you can see it's way under expectations. Nothing's happening. Okay? So now it can be harder when it's way under expectations and the range is small because the premium may be really low. All right? So it can be hard. I'm not going to say you can get them on every hour at your ideal strike. Okay, so you're looking for the right strikes, the right prices to get in. But that's the ideal setup is that volume is, not massively exceeding expectations. Okay? So just a little bit above it or right at it. And even though some of these would have worked when it did, ideally it's not. Like here, it's starting to slow down. That's good. Slowing down, good. Picking up. I'd probably back off that 20 minutes. Okay, now things are slowing back down. Now let's start getting back in. Okay? So, because you can see this massive spike. I mean, it's like double what expected volume is. Okay? One of the features that you can also do is you can go in and you can set an alert down here. You go and basically you can have alerts turned on when it gets above a certain amount. So you can say, hey, if it's above, let's just say 150%. Whoops, fingers in the right spot there. 150% of expectations. Then like sound off an alert for me so I can be aware of that. So now you see this blue line is like 150%. So that would be like really consistently, like if it's busting out of that, and especially if it's consistently busting out of that, then that's my warning sign to back off from range-bound trading. Okay? So that's more of a trending trading potential possibility, things like that. Okay? Does that make sense? So I'm looking at it really busting above expected volume, the orange line. The cyan line put it at 150%. So that way I can actually see it. The blue is the actual volume. This is how much volume happened during that 5-minute period. Question comes up on Forex. Do you have accurate volume on the Forex markets? Yes, I do, but I do not use. I don't use Forex spot. When I'm charting euro dollar, with the expected volume indicator, actually automatically pulls 6E for euro dollar, 6J for dollar yen. Okay. So we use the exchange, the CME's exchange volume on the futures market automatically. So as soon as you open euro dollar, if you throw expected volume on there, it's automatically going to pull the futures for you. Okay? So that way you're not using some OTC FX broker tick volume, because that's what most FX volume is, like on MetaTrader 4 and pretty much every platform out there is usually tick volume. It's either the broker's volume, just that one broker, okay, or it's just how many times the market changed price during that period of time, not actual contracts traded, because you need an exchange for that. And so that's why I use CME's volume whenever I'm measuring that. All right. And like I said, it automatically does it for you, so you don't have to load up multiple charts and all that fun stuff. Understand, volume like that is not going to... Do you think it's going to help you 7 hours out from now if it's succeeding for this 5 minutes or this hour? Volume is not going to help you. The further out you go in time, the less volume is going to help you. Does that make sense? As far as being able to predict range bound or breakout. So, if you're looking at doing this on hourly time frames or 7-hour time frames, volume is going to become a lot less of a factor. Okay, you can still have it on there, but it's just going to be a lot less telling for you. Okay? So we talked about how to know the expected move of the market. Just literally, if you have a toolkit on there, you go on indicators and you say add on expected range. And then, of course, you can add on expected volume. Okay, the two things I have down here. All right. Now, if I'm trading 20 minutes, I probably want a 20-minute range. Does that make sense? Yeah, because I'm looking at how far do I expect to move in the next 20 minutes. What if I want 2 hours? What do you think I would use? Like 2 hours from now. How many minutes? 120 minutes, exactly. So if I put 120 on there, it'll show me the expected range over a 2-hour period. Well, they start at 8, so we got a 10 a.m., we got an 11 a.m., 12 a.m., basically every 2 hours. So there's the even hours. Okay, I could add it on twice, and I could put on the odd hours. Okay. So right there's the even hours. So if I came in here, they open at 8 o'clock, it says here's the expected range for the next 2 hours. Here's the expected range for this 2 hours, these 2 hours, these 2 hours, down the list. Okay? Right up to 4 o'clock for the intraday expirations. You say it stayed right inside of it. Okay? That's 3 a.m., so that doesn't really apply. So going back here, because you don't have intradays. So here's, previous day here, last week. I'm just trying to show you some multiple days. Let's just get past into the U.S. session. Here's our expected ranges. Very flat week. It's also helpful to know, like, no matter what strategy you're using, is the market staying within the expected move? Is it busting out? Is it really flat to how much it normally moves? That's some of the benefits I like of having an objective expectation of range. It's like, wow, it's not just me. The market really is flat. Or it's not just me. The market really is moving. Okay? So That helps you see that really easily by putting that on there. Now, let's see here. Let's keep going. Let's say that I wanted to see the odd expiration hours. Okay? Now, I could put two of them on there, but I want to keep the chart clean for you. What I do is, it's going to start basically on midnight there, so all I got to do is just say offset this by 60 minutes. Okay? Because maybe you want to look at the 9 to 11s, right? Or you want to look at the 1 o'clock, the odd numbered expiration hours. So now what it's going to do for me is, notice how now this ends at 11. So 9 to 11, 11 to 1, 1 to 3. Okay? The 20-minute expirations stop at 4 o'clock Eastern Time. So every time I say a time, I'll be talking about Eastern Time because Nadex, their time for all their contracts is always quoted in Eastern Time. I use NinjaTrader, and we show you how to get access to NinjaTrader and all that stuff and set up the data feeds free, just right here under Education, third option, okay? And then I have the Apex Toolkit installed to grab the ranges and everything. Okay, so, that's 20 minutes. That's showing you how to do, 1 hour, 2 hour, even hour, odd hour. You can do anything you want to. So let's say you're an FX trader, okay? Or let's just say you're trading at night. You'd love to do the intradays, but they're just not there for you, okay? Well, the intradays are there for you on the FX. So go to euro dollar. Here's ranges on euro dollar. Now, what you're going to find is when there's not a lot of movement in a market, a lot of times there won't be a lot of premium. So sometimes you will need more. Like with not a lot of expected movement, market's pretty flat, right? Between, 6 and 8 or whatever. So let's say you wanted to use an 11 o'clock expiration. Okay? You don't really expect much to happen on, say, euro dollar between, 6, 7, 8, 9, 10, 11. You just think it's going to be pretty flat. And you're also pretty aware that pretty much, after, 2 o'clock, the market usually doesn't move much. Okay? On FX. So if you go in here and there's not any major news coming out that, might rock the dollar on Aussie dollar, therefore move the euro dollar. There's no major news coming out that you're all nervous about. Then you could go in and how do you set up? How can you figure out a range for when you want to start and when you want to end? Okay. So let's say I want to start at 2 o'clock. Pretty simple. All right. So if I want to start at 2 p.m. and I want to end at 11 p.m., how many hours is that? 2 to 11 is how many hours? Some of you got it right. There we go. 9 hours. There you go. So how many minutes is that? So I was going to get in at 2 for an expiration at 11. That's 9 hours, 540 minutes, right? So what I'm going to do is, I'm going to get rid of my offset on here. I'm going to say, okay, I'm starting now, and it's going to end here. How much time is that? Because that's what I care about. From now to when it expires, what is the expected range? So I put in 540 minutes. Okay? It calculates that out. Now that 540 minutes may not fall right on 2 o'clock. Let's see if it does or not. Okay, it doesn't. It falls actually at noon. See where it starts plotting? Let me show you this. See, like right here, it starts plotting at noon. So if I wanted to, and it goes for, those 9 hours. So if I wanted to start at 2, how far back do I need to push it? If I want to start at 2 p.m. and it's starting at 12, I need to push it forward how far? So if it's starting at noon and I want it to start at 2, I need to offset it and push it forward 2 hours. So I do 120. So now I'm going to get it that, 9 hours range starting at 2 o'clock. And it'll plot that all the way out till 11 for me. So now here's the expected range. That euro dollar will stay, in between 1.0685 and 1.0768 between now and expiration. And it's expected that from high to low, meaning it comes down and goes up, the expected move is looking at about 41 pips on average. Okay? So now I know, hey, ideally, I'm able to get a strike down here, sell a strike up here. Now, maybe there's nothing there. Well, I could look at, okay, 2 p.m. to 3 a.m., right? I could look at 2 p.m. to 7 a.m. I could look at 2 p.m. to 11 a.m. So I could look at, go all the way, yeah, basically 11 a.m. would be the latest one on 2 p.m. because they're 23 hours long at most on the dailies on Forex, okay? I could put these on oil at night. I could put them on the indices at night for the next end of day expiration. So there's a lot of ways you can do this. You just go in and figure out when am I starting, when is it expiring, how many minutes is that, plot it on there, find the box that the current market's in, and go, okay, how far forward do I need to push it? Okay, and instantly you got your expected ranges, and you just want an objective method for choosing that. All right. So does everybody understand the expected range piece? Like how you'd set it to be the range that you want? Okay. Awesome. Now, one thing to be aware of, deviation levels. That's one thing I like to add in and look at. So let's pull those up. Let's add on deviation levels. The deviation levels are free. You can open them up in Ninja with the toolkit there. Oh, we got to upload them. I have to reset my Ninja. I forgot about that. I have a beta version. Let's see here. Let me do a side note because I meant to reset that before. All right. Well, the deviation levels, if you open it right now, they'll plot for you. There's not plotting for me because I haven't reset. And I'll put a note over here. I'm going to note for a programmer to check something for me. They'll basically tell you where the market's expected to go, like for a daily basis. So if you're looking at longer term, like 1 day ones, you're going to want to load those deviation levels. And it's just like ranges, except for ranges are going to use historical volatility, okay, for that specific time period. Deviation levels are going to use what's called implied volatility. It's actually going to look at the market's options and pull out the expected movement forward of the options for that day. So if you are going to be looking at, 1 day, like 23-hour ones, okay, then you're going to want to also have the deviation levels on there. All right? So, let's see here. All right. Beware of news. Now, again, I want to remind you of this because, if you hop in these things, you don't know something major is coming out, then you really could be asking for it when you're trying to do a range-bound trade, right? So do you think you'd want to do a range-bound trade, right before FOMC on binaries? You can get Ninja Live, and you can get the data live for free. So don't worry about that. No, you would not want to be like range-bound trading right before like a massive news report, right before NFP. If you were, now there's iron condors that I might do if they're expensive enough, but on butterflies, not a chance because just the nature of how binary works, all or nothing. I really want it to be inside there. Okay, so check that news calendar to see what's coming up. See if Yellen's talking. See if NFP, non-farm payrolls coming out. See if employment reports are coming out. See if other countries are releasing interest rates like the pound or the euro. If major Fed heads are having press conferences, things like that. Oil inventory coming out, natural gas coming out, things like that can be really challenging to do a neutral trade on. Okay, unless it's so expensive that you can just get it super wide. All right. So this is an iron butterfly. Okay, so for collecting premium. We're going to sell an upper in the money binary. We're going to buy a lower in the money binary. And we're going to look for it to expire in between. So if I was looking at, say, the Nadex platform, okay, it's like right here. If I went on here and I was going to look at, say, Forex binaries, let's say I was going to like euro dollar, and then let's say I was going to choose a 3 a.m. expiration, okay. Then I would look to sell a contract above the market and look to buy a contract, say, below the market, okay. And I want to get that range as wide as I can get it. I mean, that's an 80 pip wide butterfly right there for about 25 bucks. Okay? So, because I can, if I sell it, I'll make 14. If I buy this one, I'll make, about $10 on the trade. All right? 80 pips wide. That's nice and wide. Okay? Now, remember, if you held the trade to expiration, I want to bring this point up for you. Okay? If I held the trade to expiration, can both sides lose? Is that possible for both sides to lose if I hold it to expiration? No, it can't both expire like above 1.0780 and below 1.700. So both sides cannot lose if you hold both to expiration, right? So if one side loses, at least the other side is making its profit. Is that an accurate statement? If one side does lose, the other side, like at least the other side is going to profit. Like you're not gonna have both. Like one could lose, one could win, but both will not lose. Now both could win, or profit, I guess would be the better word. But both of them are not going to lose unless you took it off like before expiration. Okay. Now we can make on this trade right here, like I said, about 25 bucks or so. Okay. Yeah, you can already see the time decay happening. But 25 bucks or so on the trade. Now, if I buy a contract back, let's say I sold a contract for 15 bucks. Okay? So if I sold a contract for $15, meaning I can only make $15 on the trade, I could lose 85 if I held it to expiration. Okay? And the market went back up and hit my strike. It went all the way up to 1.0780. All right? What would be the price of the binary contract? This is the one price you can always know about a binary, whether there's 5 minutes or 5 days till expiration. The price will be 50 bucks exactly. So got it. Wes got it. Jonathan, Jesse, exactly. Delinia, excellent. So if the market goes up to 1.0780, it's going to be at 50. Now there's going to, there may be a bid offer. Obviously, there's going to be a bid offer spread in there of a few dollars. Okay, so you could say, well, 47 by 53, like it'll be 53 bucks or whatever. But just to keep things simple, to get the concept down. Okay. So let's say we sold it for 15, where it was, a second ago. There we sold it for 15. It went up. Let's say we got out at $50. Let's make it an easy 50 right now. How much would you lose on that sold contract? So if you sold it for 15 and you bought it back at 50, what would be your loss on the trade? There we go. So a lot of people posted answers. We got them. Yep, 35 bucks. Okay? But you could end up making $10 on the other side. So then what would be your loss at that point? If you made 10 and you lost 25. 25 bucks. Now, the only way you're going to make 10 if you bought the thing for 90, unfortunately, is if you held the thing to expiration, right? So maybe you end up just making 5. All right, with bid offers, like a $5 bid offer spread. So let's just say you make 5. So you lost 35, you made 5. Okay, so you lost, let's say, 30 bucks. Went all the way up to 70, 1.0780. Okay, you can make 25. If you'll get out when it hits either strike, you lose 30. That's not a horrible risk-reward scenario for a market that can go up 40 pips, down 40 pips, stay flat, and be profitable. Is that a good scenario? A decent risk-reward for that kind of probability? And there are many times I can pull these off for better than a 1-to-1. Okay, this is just really flat. Okay? So, you get better than a 1-to-1, it's even better, right? We're really talking market doesn't move, market goes up, market goes down. You're still good. Okay? So, the reason I want to bring that up is because if you don't exit, now you don't have to exit, and a lot of times it'll come right back in. Okay? But if it doesn't, and you can make 25 bucks on the trade, what would you lose if it lost and you held it to expiration? So how much would you, if you could make $25 on the trade, how much could you lose? It's going to be 75. Yeah. So if you can make 25, you could lose 75 if you held it to expiration. Okay, if you can make 35, you lose 65 if you held it to expiration. Okay? Still may not be a horrible scenario depending upon what your win-loss ratio is. Okay? But a lot of people I know prefer to hop out if it does hit one of the two strikes. Okay? They'll get out of both sides because they don't want both sides to become a loss. Okay? This is not a trade I usually close to take profit early unless I'm closing out both sides at one time. Because if you pay the bid offer spread on both sides, that gets really expensive. Your $25 profit just became a $15 profit. Okay? So usually I'm leaving this one on. This is one that I actually do often hold into expiration. Now, if the market is close to one of my strikes, is it a good idea for me to leave that thing on till expiration on the one that it's close to? No. If it's 30 ticks away and I got 2 minutes to go, I'm going to leave it alone personally. Okay? If it's a few ticks away, and I'm like, you know what? I don't care. I'll take a $10 hit on one side. I made 10 on the other. Maybe I break even. Whatever. Okay? So, question comes up again. How do you get out before to get profit? You'd have to have more than $25 total to get out before. Because otherwise, you're going to pay like $5 in bid offer spread on both sides. You're going to make like $15. So we could go further out, and we could look at, bump it to 11 a.m. and see what we can get. Here's a 1.080, and go down here. 1.070, so that's 100 pips wide. Getting $45 on that one, that's one that you could, more likely take a profit on, right? So if I was selling, say, this contract and buying, this contract. So I can make 14 on one side, that's 35 bucks on that one. So, okay. Now, would I just want to pick it based on the price, or would I maybe want to check and see if that even is a good price based on the expected range? Yeah, I want to check. I don't just want to blindly stick these on and go, 30 bucks. Okay, I'll take it. Okay, well, news is coming out, and it's one of the most volatile periods, so you're about to just get hammered. Okay? So, yeah, you want to check. Okay? Don't be trading blind. Don't just trade the binary price. So it's a mistake I see a lot of newbies do. They're like, buy that one, sell that one. See what happens. They have no idea. They haven't even seen a chart. So don't want to do that. Let's see here. So unless you're 35 bucks, you might go in and you could, set a take profit on that one. To know what price, by the way, and this is a helpful tip for you. Should I set a profit to, say I buy this one I sell this one at 20. Should I set a take profit? What should I set my take profit at? And this is a really helpful tip if you understand what I'm about to tell you. Okay? Look at the prices on this ladder. Should I set my take profit to buy back at $1? Will it get filled? Probably not. There's not a single contract listed for $1. It could miraculously, but I mean, somebody'd be sort of stupid, right? They're gonna pay a $1.80 round turn. Pay 90 cents in fees. Why would they buy it for a dollar? Okay, so or sell it to me for $1. They can't make any money. All right. So when I'm looking at this, I see a $3 one. Well, it has to move like really far to get to that $3. I see a $5 one, but look at this 550 one. Okay, for 50 more cents, if I said $5, that means I'm going to wait on it to move another 20 pips to make 50 more cents to grab my profit. So what would probably be the wiser one, the 5 or the 550? Do you want it to? Yeah, you don't want it to move $20 to make 50. To make an additional 50 cents. So look at that binary price ladder, and that'll help you determine what may be the better price to choose. Okay? If you're doing size, you want to get out before the bid offer spread goes away. Like let's say you're doing 20 contracts or 100 contracts. Notice when there's no bid, because nobody's going to sell to you at zero. They can't make anything. Okay? There's no size. When there's a bid and offer, there's a size. So if I was doing 20, 50, 100 contracts, all I need to do is look at what is the bid offer. It's about $5, okay, on these contracts. Maybe $6. So I need to get out, $5, $6. Okay, so buy back at like say 6 or something if the bid offered like 5, so I can get out of my 100 contracts, make sure that liquidity is there. If I wait until the bid offer is gone, it's going to be getting out 5 at a time, 5 at a time, 5 at a time. Okay. It's the person's like, that just made me look greedy for 50 cents. Exactly. So just be aware of that. Now, if you're only doing one, you don't care if it's 525, whatever, 550. But if you're doing like 20 contracts, you need to really, if you're doing higher than more than 5, you need to be looking at your bid offer. Okay, making sure there's a bid offer size. Now, if you see this like a 1, that means some trader has an order in there. So now it's 101 because it moved up. But there was an order in there for one contract at 76.50. Like the market maker probably had like 77.50 at 100. Okay? But hopefully that'll help you determine where to set your take profit, so you're not just randomly picking $1 and stuff like that, and you're not picking one that's 20 ticks away for another 50 cents, so that can save you some pain. Okay? Now you can go through. Now, what if you want to do this on multiple markets or multiple expirations? You're gonna have to click through all of them. Okay? If you want to make it easier, then you can use a scanner, which is free. Let's go back over to the scanner here. And go down, select the markets you want to trade. So let's say it's nighttime, and let's just say I'm looking at these. I can say, you know what, I want to look at just in the money contracts. And I want them to have at least, we'll just say 6 hours till expiration. And not more than a day. Okay? Well, now I can go down and I can see the expirations for 3 a.m., 7 a.m., 11 a.m., 7 p.m., okay, on all of those markets and without clicking anywhere. So all 4 markets, all the expirations are right there. So if I look at this and I'm like, yeah, that's too close, I may go down and maybe I'm looking at multiple instruments. So there's a $30 one. That's not bad. You go over here. Let's see. Get this one for, that's even wider. Okay, so that's 100 pips wide for $40. But I'm going until 3 o'clock tomorrow. Is 50 pips up, down? Is that within the expected move of the Aussie dollar? I don't know. I got to go over and look at the ranges. Let's see what the expected move is. All right. So by using the scanner, I can quickly identify if there's one I like or not. Maybe if I don't like the Aussie, maybe I like the euro, maybe I like the pound. So that way I'm not just stuck on one expiration on one instrument. I could load up a variety of instruments, put the ranges on them, and then go through and find ones that match what I'm looking for. Makes life a lot easier. And it's basically what it's telling you here is this is the Aussie dollar. Here's the symbol. This is the max profit on a buy. max risk on a buy, max profit on, or max profit on a sell, max profit on a buy. So your risk and reward, your risk reward ratio right there. It'll also tell you what the price will be approximately when it gets there, like 77.40. Say, well, what if the market moved to 77.40? Then it'd be right at about 50 bucks. So, and it's even got the bid offer built in there, 54.50. So, if I sold for 19 and it hit at 77.40, I'd probably be getting out at 54. Okay? So I'd lose, 35 bucks on that. I could make 18 on this, so let's just say I make 13. So not a bad risk-reward ratio trade. That's a $40 trade. And actually with a little bit lower than a 1-to-1. So better than 1-to-1 risk-reward ratio on the trade. So that helps me quickly identify that. I can go over here and I can say, well, what if I did, 0.7680? What would that one be at? And you'll right there, 45 bucks. Okay, so right around that 45, 55 range. So $50 mid price. So if I sold for 82, or if I bought it for 18, okay, and it moved against me, what price? I'd lose basically $37 on the trade. Like if it moved down on my buy. And then I could make 20, so we'll say I make 15. So if I lose 36 and I make 15, then I lose 20 and I can make 40 on the combination. All right, I'll take that any day. I mean, that's a nice risk-reward trade. That's a 3 a.m. trade. Okay? So understanding how to get out of the trade to limit that risk and how to put both sides on to have profit to help cover the other side help makes the trade work a lot better for you. And then having the expected ranges helps out a whole lot for knowing like what kind of strikes you're looking for. All right, let's see here. So, some examples like on 20-minute binaries, looking at expected ranges to 20 minutes, looking at volume, things like that. Let's see today's chart. Let me pull up today's. Well, we already had today's up. But like here, I have S&P, I have the small cap, I have the Dow. Sort of, whichever one you prefer. I have 3 of them on here just as an example. These are today. 4 o'clock as an example. Hey, we need to do some, good examples that are current versus having the December ones up there. And so hopped on, put a few on all the indices. This one bought below the market, sold above the market. Bought below the market, sold above, bought below, sold above. And they all expired in the money. So now that doesn't mean I made $100, right? If I put up 80 bucks risk and I got a $100 payout, every one of those is butterflies. If I put up 80 bucks and I got a $100 payout, how much did I make on that contract? Made 20. Okay. So right here, made like 19, made 13.75, made 15, made 14, made 15.50, made 15.25. Okay. On trade. So about 30 bucks on each one of these. This is hopping into like right on the top of the hour. Okay. So just to show you an example of what a butterfly looks like, when you put on the order, and the scanner will actually let you, as you notice, will let you actually have all of them in the same spot, and it'll line them up and group them together, which is sort of nice. And then you just monitor the trade to manage your risk, or you can go wild on it, and it may a lot of times it'll go out of it and come right back. So some people just decide to leave them on, but just understand one loss may wipe out 3 profits, if you do something like that. So, let's see here. Trying to look at. Okay, here we go. Just Dow. If we zoom in on it. So go right in here. This first 5 minutes right here closes down. Volume's below expectations. It's like right at it. Okay. For the first 5 minutes, go ahead and look on it and see if you can get one on. If you went on, awesome. Now they're not always going to be like right at those expected ranges. A lot of times you're going to have to push further out to pull that off. Okay. But I want to give you an example of it and to show you the effectiveness of it. If I'm going tighter, That's why I like the volume, because if I want to go tighter than the expected range, that lower expected volume gives me more confidence to do it. Um, let's see here. So minimum, maximum prices to enter at. I mean, obviously it's in the money, so whatever in the money is. But I mean, you could, I mean, get as high really as $30 on each side. So buying at 30 and selling at 70. Really going higher than that, you're probably getting really, really, really close. So more often than not, you're gonna be looking at 15 or $20 on each side. So the question was, did I let those go to expiration? Yeah, that's why you saw the $100 settlement payout. You never see that on a closed trade. You only see it on a payout held trade. So most often I will let them just go to expiration. Yes, unless they're really close to my strike. Um, so we talked about comparing the strikes to the ranges. Pulling up the range, looking at the strikes, looking at the volume. Okay, what time frame to enter? I mean, really anytime you want to. You just obviously the further out in time you go, the wider they're going to be. Okay. Um, Profit targets, like I said, very rare that I use a profit target unless I'm getting it better than 1-to-1. If I'm getting better than 1-to-1, then I'll look at doing a profit target. And if I do that profit target, I probably want to close both sides. Okay. Um, and then, but I mean, you can do this at night. At night, you're probably definitely doing more time. You can do them during the day, 20 minutes, hour, 2 hour. I mean, you can go all the way up to a week if you want to. Then obviously exiting when the strikes are hit. So we talked about exiting when one side of the strike is hit. Exit both because you don't want the other one to come back and lose. Like you lose $35 on one, the other one comes back and loses like 85. You just jacked up your risk reward model. Okay, so exit both if you're going to exit. Um, and I mean, you can use whatever expected ranges you want. So just make sure it's the amount of time from when you start to when it expires. Okay, find out what those minutes are and then set the offset in there. So a question comes up: if volume is low, would you want to keep your strike as tight as possible? I mean, I want my strikes as wide as possible. I'll be more willing to go tighter between them if it's low, right? But I want them. I mean, the further wide out, the further apart they are, the further the market has to move to expire. You know, out of the money on one side or the other. Does that make sense, Rob? So the question was again: if volume was low, would you want your strikes to be as tight as possible? I want them as wide as possible. I'll just allow tighter than the range if volume is really low. Yeah, you get more premium, but you also lower probability. So you got to weigh that. I mean, one tick is all it takes. Um, Question about again CME volume and Forex markets. What I do is the expected volume indicator pulls the CME's futures volume, like 6E for euro dollar. So that way I get exchange based volume when I'm trading spot Forex. Like if you're trading euro dollar, you're looking at spot FX. So if I'm looking at spot FX, then I want to pull the euro dollar futures. If you're trading the binaries, they're based on spot FX. So you're going to euro dollar, but I want exchange based contract, like futures contract volume. So like 6E, 6J, 6A, 6C, 6S, etc. But this automatically pulls all that data for you. So it's plotting the futures for you when you open Eurodollar or whatever. It even has a mathematical thing to calculate the ratio variance for, crosses like Euro Yen, Aussie Yen, stuff like that. Does that answer your question, Marlon, on FX using futures based volume? Because you don't want to use tick chart volume like MetaTrader. I know so many Forex traders come into the world learning on MetaTrader, like they're born into MetaTrader and they think they have to stay with it because it's so simple and clean and easy and low resources, and that's great, but you don't have real volume. So you're basically trading without volume is one of those things you need. Price action, you need volume, you need proper expectations of movements. So you're trading with like one leg on a three-legged stool, and it's hard to keep that thing balanced. So, not to mention that FX brokers can see right through it and see your stops and take profits on MetaTrader. So, one of the reasons I don't like it. So, These charts are 100% free. What I'm showing you, as far as the data, you can get the FX data, you can get the futures data, and you can get the platform and the deviation levels at no cost. So there's no reason to go with an option that doesn't give you all the data for free, futures and forex. So, but and as far as like web-based charts, I do not like web-based charts at all. So they're usually often delayed or based on some sort of indicative average price, and you're not getting futures unless you're gonna be opening them up. I mean, it's just like why use less when you can get more for free? Um, let's see here. Can you do this on 5 minutes? You can try it. There's a lot of flat 5 minute periods, I'll tell you that. So you can try it. So I have not done it myself. I mean, you're looking at maybe at best. I mean, we can look at it. Let's look at it right now. Let's see here. Where did I put that scanner? There we go. So go over here. Bring this on down to 5 minutes. Here's all our 5 minute contracts, which is nice on one page. Um, I mean, you're looking at about 6 ticks wide. Make $25. Not horrible. Right there. But I mean, 6 ticks wide means like a few ticks up or less, a few ticks down or less from where the market's at that moment. There's not one on the pound dollar. We got like a 32. I mean, you got basically a 3 tick wide one, so I would not be touching that. And I mean, that one's not horrible. You got 28.85, but I mean, it's just a few ticks. It's only 3 ticks wide. I'd rather just strangle it myself. So, um, if you can pull off a 6 tick wide, demo it and see how it works. We have the ranges on 5 minutes, so you'll find out pretty quick. Remember, you can't really exit to take profit unless you. I mean, yeah, the bid offers are a lot wider on 5 minute contracts. Okay, so you're not going to be able to exit to take profit. So you're basically, if you're in that trade, you're most likely in that trade till expiration, or until it gets hit, which could be like 2 or 3 ticks away. So you're going to weigh the pros and cons of just doing them and see how that works out. Because you're not going to be able to get out of one. You may be able to get out of one side like around 50, maybe. And the thing is, they move so fast. Okay, I mean, like literally a couple ticks, it can go from 20 to 50 to 80. So, um, the training is free. The scanner is free. Okay, the platform is free. The data feeds are free. The deviation levels are free. So we do have trials if you want to try out the expected volume and expected range with the essentials package. It's like $7. Try it out. Let's see here. Completely off topic, but I just went through. Oh, yeah, it's very off topic. Okay, we'll come back to that in a second. Okay, are there any questions on iron butterflies? I mean, so far they're in the money. Those two. It is what it is. Exactly. Dark Zone live. Yeah. Um, And the dark zone is when you stop seeing the market makers post quotes. Sometimes you'll see stuff in there. If we go to live, it'll really boom. Demo will have all sorts of stupid stuff in there. Um, but Jeff, I mean, yeah, you could do an iron butterfly on 5 minutes. It's something that I've actually added to my list of 500 ideas I want to try. So I mean, it's one of those things to sit there and just start picking them off. So see if they work. I mean, right now you'd be looking at it, you'd go, okay, well, I will sell that one and buy that one and see how it works over the next 5 minutes. If it works, then I make. I mean, it isn't bad. $40, lose 60. That's not a horrible one. So as long as it stays within that range. We got monetary policy minutes coming out in a little bit, so things probably are pretty quiet right now, which is good. Um, let's see here. But I'd make sure they were always 6 wide. I would never choose a 3 wide. Um, yeah, we'll know in 3 minutes whether or not that one works. The last two worked that we did. Doing them on the 5 minute ones. Like, how is it that the term of the webinar is long term binaries and we get 5 minute butterfly questions? um, let's see. How to pick the contracts again. One, you're going to make sure they're both in the money. So what I'm going to do is I'm going to say, in the money right here on the scanner. It makes it easy. Okay. What that's going to be is a buy below the market, a sell above the market. Okay. And then you set your timed expiration. Makes it easy. Okay. Um, so if you want longer ones, you choose longer ones. Okay. Um, and then so if we go over here, let's say we want, ones that are, we're looking at an expiration that's like 4 hours or a day or whatever. Then I'll pull up the chart and I'll look at the high of the expected range, the low of the expected range. I'll look at the volume and I'll try to get a strike as close as I can to the high and low of the expected ranges on the charts. So where I can get at least $25 on the trade. So if I was looking at this chart, I'd be looking at it, and ideally, I'm able to get ones as close as possible to the high and low of these periods. Now, if I see volumes horrible, like right here, I guess way under. Let's zoom in a little bit more. Then, I could go a little bit tighter. So, yeah, another one is on the 3-tick charts. Looking at where there's just a whole bunch of cyan arrows, and they're sitting there, and they're longer than 3 minutes. When you're getting that longer than 3 minute bar, that'd be a good time to check out, possibly popping on a butterfly. That's a good idea, Wes. Yeah. So looking at the trend catcher cyan arrows, where the bars are longer than 3 minutes. An example for those who don't know. Let's see here. All right, so here is the 5 minute charts up in our room, in our elite room. You get access to that as essentials as well. But what he was talking about is like if they're longer than 3 minutes, which is where this blue line is. You can barely see it on this one, but where the blue line is, that's basically marked at 3 minutes, or should be marked at 3 minutes. Yeah, it is. It's at 3 minutes. Then if it's greater than 3 minutes, that'd be a time to possibly look for a butterfly, because that means nada is happening on the market at that point. So yeah, I'd say over the 3 minute would probably be the rule. So if it's taking longer than 3 minutes for it to make like basically a tick, then you're sitting in a 3-tick range. Then that's a good that'd be a way to look at the butterflies. That's a good idea. Yeah, that would definitely not be long term. It'd probably feel very long term. That'll make that 5 minutes feel like it's 5 hours because it'll be so close. But so yeah, you may have to. You probably get $30, $25 to $30 pretty easily at the top of a 5 minute period. So on most markets, if you can't, then you could always leg in. You could put one above and one below and let it oscillate back and forth. Just make the hard part is that really hurts you if it goes against you and you don't get the chance to get out. Um, let's see here. Trying to make sure I got every other iron butterfly question. Why do you sometimes have a divergence between your volume and your range? You would expect a lower volume to turn tighter ranges. Trying to see what you mean. You'll see that the volume is higher in the higher expected ranges. You notice how the ranges get larger, and notice how the expected volume actually increases. So those are actually pretty close on par there. Let's see. A question about Elite MVP. Is that for spreads only? There actually are binary trainings. If you go to the Elite MVP section of the forum, we actually have binary trainings on how to apply it. Profit poppers and the momentum scalpers. Last Thursday, I went over how to actually go in and just knock out 1 hour binaries one after the other on what I call a reversal scalp. You can check out the recent webinars for that as well. All right. Well, I think I got every question. There's a lot of information there. I did record the webinar for you. I hope that you picked up a few tips, some things to think about. Just thinking about ranges, period, like transforms how you look at charts. Um, and just, understanding the concepts that will affect your trend trading, your strangle trading, your butterfly trading, just understanding those ranges. So hopefully y'all picked a few things up, and you can apply some of this to your own systems or strategies, or the ones that I use and teach, or whatever. But as long as you got something from it, you took a little gold nugget away, then you're better off than you were when you started. So that's good. All right. Well, thank y'all very much, and y'all are very welcome. So I appreciate that, and y'all have a wonderful evening.